Hello, everyone. Right now, as you are watching this, there is money tied to your Social Security that you have not checked. Not money someone owes you in theory, money that has already been estimated, already reserved, or already being withheld from your check every single month. And that can stay exactly where it is unless you know to ask for it. Most seniors who find out about what I am covering today react the same way. They wish someone had told them sooner. Today, I am going through 5 specific situations, a checklist, and I want you to go through each one and ask yourself whether it applies to you. Most seniors watching this will find at least 2 that do, and each one is worth real money. Before we get into it, subscribe to this channel right now and turn on the bell. This is exactly what I cover. Money that is due to you that the system does not proactively hand over. The people subscribed here learn before the window closes. Subscribe now and let's get into it. Let's start with something that is quietly taking money from roughly 4 out of every 10 Social Security recipients every single month. And most of them have no idea it is happening. When you first enrolled in Social Security, or at some point after that, you may have filled out a form called the W-4V, the Voluntary Withholding Request. This form lets you choose to have federal income tax withheld directly from your Social Security check at a flat rate. 7%, 10%, 12%, or 22% of your monthly benefit. If you filled it out, that rate has been applied to every single check since the day you submitted it. The SSA does not review your tax return. It does not check whether your withholding still matches what you actually owe. It follows your original instruction month after month, year after year until you submit a new form. Here is why this matters right now in 2026. That high-profile recent tax bill floated in 2025 outlined a new $6,000 senior deduction that layers on top of the current standard deduction. For a single filer 65 or older, the total combined deductions can reach $24,150 before you pay a single dollar of federal income tax. For a married couple where both spouses are 65 or older, the combined deductions can reach $47,500. For millions of seniors whose income falls within those thresholds, the estimated federal income tax on their Social Security can be 0, but their W-4V still says 10%, which means $200 to $400 per month is being sent to the federal government in advance of a tax liability that no longer applies. It comes back as a refund in April. It was never the taxpayer's money. It earned no interest. And the fix is one new W-4V selecting a lower rate or 0. To find out if this applies to you, look at your Social Security payment stub or your SSA 1099. If you see federal tax withheld, that amount is being deducted from your check every month. Download Form W-4V from irs.gov. Select the rate that reflects your actual estimated tax liability, or select 0 if your income falls below the deduction thresholds. Sign it and mail it to your local Social Security office, not to the IRS, to the SSA. Processing takes 30 to 60 days, and your next check reflects the updated amount. Item 2 on the checklist. Are you paying federal income tax on your Social Security when you may not owe any at all? Whether any portion of your Social Security is federally taxable depends entirely on a calculation called provisional income. Here is how it works. Take all your income outside of Social Security, pension payments, IRA withdrawals, interest, dividends, any part-time earnings. Add any tax-exempt interest you receive. Then add 50% of your total annual Social Security benefit. That total is your provisional income. If your provisional income is below $25,000 and you file as a single taxpayer, none of your Social Security is federally taxable. 0. For married couples filing jointly, the threshold is $32,000. If you are below these numbers, your proper withholding rate on Social Security is 0, regardless of what your W-4V currently says. If your provisional income falls between $25,000 and $34,000 as a single filer, up to 50% of your benefit may be taxable. Above $34,000, up to 85% may be taxable. The thresholds for married filers are $32,000 and $44,000. Take 5 minutes right now and run this calculation with last year's income numbers. If your result falls below the zero tax threshold and you currently have withholding set up, you have been prepaying a tax you do not owe. The W-4V fix in Item 1 addresses both problems simultaneously. Item 3. If you are a widow or widower, are you receiving the right benefit? This is one of the most consistently missed and most financially significant situations in Social Security. When a spouse passes away, the surviving spouse has the right to receive either their own retirement benefit or the deceased spouse's benefit, whichever is higher. A widow or widower can receive up to 100% of what their late spouse was receiving at the time of death. The SSA may not automatically move you to the higher benefit. In many cases, a surviving spouse filed for their own retirement benefit years before their spouse passed, and they continue receiving that same benefit indefinitely, even if their late spouse's benefit was substantially higher. The difference between a widow's own benefit of $1,400 per month and her late husband's benefit of $2,200 per month is $800 per month, $9,600 per year, and it continues for the rest of her life. If you lost a spouse and you are currently receiving Social Security, call SSA directly at 1-800-772-1213 and ask them to pull both numbers, your own benefit amount and what you would receive on your late spouse's record. Ask them to confirm which one you are currently receiving and to calculate the difference. If your late spouse's benefit is higher and you have not switched, request the switch in that same call. This applies whether your spouse passed recently or years ago. Item 4. Did you ever work in a job that did not pay into Social Security? And have you checked whether you received the correction you are now legally owed? Teachers, police officers, firefighters, federal employees, and other public sector workers in certain states spent their careers contributing to a separate government pension instead of Social Security. For decades, two provisions, the windfall elimination provision and the government pension, offset, reduced, or completely eliminated the Social Security benefits these workers or their spouses were entitled to from other employment. The Social Security Fairness Act, introduced in January 2025, currently addresses both provisions and seeks retroactive full application to January 2024. SSA has been reviewing these cases throughout 2025 and into 2026. The average retroactive lump sum payment has been approximately $6,710. Monthly benefits have risen by about $360 per month for affected retirees overall. But not every eligible person has received the correction yet. Some cases, particularly spousal and survivor benefit adjustments, are still being reviewed as of mid-2026. If you spent any part of your career in a public sector job with a separate government pension, log into your My Social Security account at ssa.gov right now and compare your current monthly benefit to what you were receiving before January 2025. If the number has not increased, call SSA and ask specifically about your WEP and GPO adjustment under the Social Security Fairness Act. If you are the widow or widower of a public sector worker, you may also be entitled to a retroactive payment and a permanent benefit increase. That correction requires you to ask. Item 5. If you claim Social Security early and regret it, or if you are past your full retirement age and have not yet filed, there are two options most people never hear about. The first is Form SSA 521. If you filed for Social Security and your first payment was received within the last 12 months, you can withdraw that application, repay everything you have received, and refile later at a higher benefit level. A woman who filed at 62 and receives $1,920 per month could withdraw, repay the month she received, wait until 70, and refile at $3,379, a permanent $1,459 monthly increase for the rest of her life. The 12-month window from your first payment is the hard deadline. Miss it, and this option is gone permanently. You are also only allowed to do this once in your lifetime. But for someone who claimed early under financial pressure and whose situation has changed, this is the most powerful correction available in the entire system. The second option is for those who are already past their full retirement age, 67 for anyone born in 1960 or later and have not yet filed. After full retirement age, you can request up to 6 months of retroactive payments as a lump sum when you do file. on the current average benefit of $2,810 per month. 6 months comes to over $12,000 delivered with your first payment. There is a trade-off. Your ongoing monthly benefit is slightly reduced because your start date moves back, but the option exists and SSA will not mention it unless you specifically ask when you call to file. So, here is your checklist. 1. Look at your SSA-1099 or payment stub. If federal tax is being withheld, run the provisional income calculation from Item 2 and submit a new W-4V if your withholding rate no longer matches your actual tax liability. 2. Calculate your provisional income using last year's numbers. If the result falls below $25,000 single or $32,000 married, your proper withholding rate is 0. 3. If you are a widow or widower, call SSA and ask them to compare your current benefit to what you would receive on your late spouse's record. 4. If you ever worked in a public sector job with a government pension, verify that your WEP and GPO correction has been applied and that you have received the retroactive lump sum. 5. If you claimed early within the last 12 months and regret it, download Form SSA-521. Now, if you are past full retirement age and have not yet filed, ask about the retroactive lump sum option when you call SSA. 5 items. Most seniors watching this qualify for at least 2. Every one of them requires you to take action because the system will not do it for you. Subscribe. Share this with someone you know who receives Social Security.